Greetings to everyone. You're all welcome to Pros and Cons Accountancy Tutorials. My name is Edward, and you can call me Ed for short. Today, we want to focus and start our session on business combination. So our focus today is on business combination. All right. So I believe most of us who are doing either ACCA, ICA, or any professional course, or even academia may have heard of business combination. And so today we want to start the session on business combination. I believe we may not be able to finish everything today, but we will try as much as possible to give um bit explanation of everything that we need to talk about and make sure our videos are in short forms so that watching it will not be we will not prolong the video, right? So we will talk about some part of consolidation, or let me say business combination today. As time goes on, we focus on other sessions on business combination as well. So let's begin. Now, the question we want to ask ourselves is, what is business combination? So as a layman, if we talk about business combination, the idea is we're combining what? Businesses. It may be one, two, or three businesses or more businesses that we are combining together. But you ask yourself, is it that we are bringing these companies together to change the name, or what is it, right? Is it that one is buying the other, or one is buying other companies? So that becomes the question that as a layman you may be asking yourself. Well, when we talk about business combination, um, it's more or less a transaction, right? Where one company will purchase the other company, or will purchase one or more companies. So in that case, in preparation of financial statement, we say bring all of them what? Together. And therefore we call it a business combination. So in your preparation of financial statement, you are going to bring all these companies together as one in terms of preparing your financial statement. And therefore, we term this as what? You combining what? The businesses. You combining the businesses. And that's why we call it business combination. So in that case, then it means we are going to have an acquirer and acquiree, an acquirer and acquiree. So the person the company that is going to purchase another company becomes the acquirer, whilst the company who is going to be purchased, the company going to be purchased will be the acquiree. It means there should be some level of control, right, for which the acquirer will have on the acquiree. There should be some level of control for which the acquirer will have on the acquiree. But we call something level of investment or investment levels. Your control will be based on the level of what? Investment, or it will be based on the investment level. When I mention this, I'm talking about where you have acquired a company, but you didn't acquire more than what? 50%. So let's say you acquired less than 50%. In that case, you do not have maximum control over that company, right? You do not have maximum control over that company. So one of the investment level is whereby you purchase anything less than what? 20. Anything less than 20. So you purchase any percentage less than 20 of another company. So one, we are talking about where you are purchasing less than what? 20. You are purchasing less than 20. So in that case, we are saying you do not have control. You don't have control over that company. It's just an investment that you've done in the company. The company, you don't have utmost control over that company. It's just some mere investment that you've done. And that one will focus on the standard that we will deal with in the near future. This standard is what we call IFRS 9, financial instrument. So You've invested in that company. You treat it as what? You invest in some finances in the company. That is where you have purchased anything less than what? 20% of the acquiring company. All right. So the other investment level is purchasing 20 and above, but not more than 50. You've purchased 20 and above, but not more than what? 50. So in that case, we say you have significant influence. You have a significant what? Influence. You do not have ultimate control, but you have what? Significant influence. Significant influence because you don't have more than the other shareholders. So you have purchased something either 50%, so it is 50-50 now, or something less than what? 50. In that case, you do not have control over the company because others, they have more than you, or if we combine the others, they will be more than you, or it will be what? Equal percentage, which is 50-50. All right. So, as I said, you just have significant influence, but you do not have what? Control. Now, the investment level where you have less than 20, it means you don't consolidate because you don't have control. So you have to find the fair value of your investment in that company. Then you take it to your what? Your financial statement rather than consolidating the two companies. No. So you find the fair value of your investment and then you treat it as what? Investment in the acquiring company. Same way, when we talk about anything less than, although more than 20, but less than 50, or equal to what? Just 50. We say you have significant influence. You have significant what? Influence, but you can't also what? Consolidate. We call that one an equity accounting. So in that case, the company becomes more or less like an associate to you. It becomes an associate to you. So the first one is a financial investment. The second one is what? An associate company. So for an associate company, you are only looking at the gains that you are getting from that company and the fair value of what the investment that you've made in that company, right? The gains. So if it is profit, you take the profit to your uh, P&L. Then you add the profit as well to the amount that you paid in acquiring what? Such a percentage. You add it to what? You add it to the amount that you paid in acquiring such a percentage. That becomes the fair value of the investment you have in the acquiring company. So the acquiring company now is an associate to you. All right. Now the third one, which is the third level of investment, is where we can consolidate. So in that case, you are purchasing more than what? 50%. You are purchasing more than 50%. Let me show some let me say bits of this on the board so that we will have an idea of what I'm talking about. Just a summary of what I just mentioned. So let's look at this. So you can see we have the investment level where we have the acquisition. So the acquisition, if you purchase less than 20%, you have no control. And then your status, you cannot also what? Consolidate. Same way when we come to the accounting treatment, we are saying you are using IFRS what? 9. IFRS 9. So we treat it as a non-current what? Asset. IFRS 9. Either a current asset, if it is just for 1 year, it becomes what? A current asset. If it is more than 1 year investment, then it becomes what? A non-current asset. So find a fair value, then that will be all in your financial statement. The second one is where you are purchasing what? 20, in between 20 and what? 50. In between 20 and then 50. So 20 to what? 50. So we say you have a significant influence. And in that case, you become an associate, no consolidation. No consolidation. So we use an equity accounting method, which is IAS 28. IAS 28. The third one is where you've been able to purchase more than what? 50%. You've been able to purchase more than 50%. So if you purchase more than 50%, we call something a parent. So you have more. So in this case, you become what? A parent, whilst the company becomes what? A subsidiary. The acquiring company becomes a subsidiary, whilst your company becomes what? A parent company. So then, if we have parent and subsidiary, then we can consolidate the two companies. We can now consolidate the two companies. So we consolidate it and make it what? As if it's a single entity. As if it's a single entity. Now, business combination or consolidation is IFRS what? 10. International Financial Reporting Standard 10. So anytime you hear of business combination or you hear of consolidation, that is IFRS 10. So we call it consolidated financial statement. Consolidated financial statement. So that is IFRS 10. However, the name business combination came out from IFRS 3. IFRS what? 3. So we can have a look at IFRS 3 and what it says there, where it will also be talking about recombining the goodwill that we are going to get out from it and other issues that it will talk about. But consolidated financial statement is IFRS 10. IFRS 10. All right. So once we have this, then I think we will be able to move on. Now, let's talk about where we are saying that we have a control. Under what circumstance can we say that we have a control over another company? Under what circumstance do we say that we have control over another company? So in saying that we have a control, we can only say that we have a control, or let me say, according to IFRS 5, we can say we have a control where we have power over what? The investee company. Where we have power over the investee company. In that case, it means we are the majority shareholders. So we have power over you. We are basically what? The majority shareholders. So we have power over you, and we can use our power to what? To control how surpluses should be shared and those kind of things. So we have power over you. So when we say you have control over another company, it means you have power over an investee company. That is one. Now, the other way for which we can say we have control over another company is that whereby we have right to variable what returns from what involvement with the investee. So we have some right to some variable what returns over our involvement with what? With the investee. So surely we will have some variable returns from our involvement that we have in the or with what? With the investee company. With the investee company. So surely we are going to have some returns, and that returns we have right on it. And all is coming as a result of what we having associated ourselves with what? With the investee company. One last thing that we can say about control. Where in first we said we have power, right? But can we use our power, right? So where we are able to use our power over the investee to let's say affect amount of what? The returns. Affect the amount of what? The returns. So all what we are trying to say is that at the end of the day, I have power over you. So I should say I have control where I can use that power over what? The returns that we are going to share. Right? I can use that power over what the returns that we are going to share. So let's go to our board and write out. Oh, I think I have it in my notes. So let me share. Good, good. So when we talk about control, there's the three circumstances under which we can say we have control over a particular company. So power over the investee, and then exposure or right to variable returns from involvement with the investee. And lastly, the ability to use power over the investee to affect the amount of those returns. In this case, we say then we have power over the investee company. So if you look at the last investment level, we said you purchased 50% and you will have to have, in that case, you can consolidate. But there are some exceptions from preparing consolidated accounts or from preparing consolidated financial statement. What are those exemptions? So let's look at those exemptions and move on to look at other things, right? What are those exemptions? So with those exemptions, we are saying that though we've been able to purchase 50 more than 50%, but instead of you consolidating, you did not consolidate. Why did you not consolidate? Because the standard actually says that if you've purchased more than 50%, then you have to consolidate. Why are we exempted from what consolidating or preparing consolidated financial statement? One issue is when the parent company itself, right? The parent company itself is a wholly owned subsidiary of another entity, and of which that entity is preparing what? A consolidated statement. So let me use pros and cons as an example, right? Let's say pros and cons purchased Ed company, let's say 60%. Pros and cons purchase 60%. What it means is that pros and cons have to prepare consolidated financial statements where it will be between pros and cons and then Ed company. Together, it becomes what? A consolidated financial statement. But this time around, pros and cons itself is a subsidiary company of, let's say, Boache company. So pros and cons itself is a subsidiary company of what? Boache company, meaning Boache company has also purchased more than 50% in pros and cons, whilst pros and cons has gone on to purchase what? Also 60% in Ed company. We are saying because pros and cons is a subsidiary to who? It's a subsidiary to Boache company. And Boache company prepares consolidated financial statements. Then pros and cons can be exempted from what? The preparation of consolidated financial statement. So that's why we say when the parent company, who in this case is what pros and cons, is a wholly owned subsidiary. So pros and cons is a subsidiary to what? To Boache company. And Boache company prepares what? Consolidated financial statement. Then we say pros and cons can be exempted from the preparation of consolidated accounts. All right. So one other issue on the exemption is the parent's debt or equity instruments are not traded in the public market. Well, if you are not traded in the public market, if your shares are not in the public market, nobody, because who is controlling you, right? Which organization is actually controlling you, right? It means no one is coming to force you for the preparation of even your own financial statement. So at the end of the day, what we are saying is if you are not traded publicly, if the parent company is not traded publicly, then it's not by force to prepare financial statements. So in that case, consolidated financial statements. So in that case, they will be exempted from the preparation of financial statements. Or you'll be exempted from the preparation of consolidated financial statements or consolidated what? Accounts. Last is that the parent did not file. So if the parent itself has not filed its financial statement with the Security Commission, the parents, they've not filed their financial statement with the Security Commission or other regulatory organizations. So no organization regulates them, right? filing your financial statement with the Security Commission simply means that you have a regulator. Also, filing with regulatory commission means that you have a regulator which will regulate you to prepare the financial statement. But in this case, you have not filed your financial statement with any commission or any regulatory what organization. So nobody regularizes you. So in that case, who is going to force you on the preparation of what? Consolidated financial statements? No, no one. So we say in that in this term, then you are what? Exempted from preparing consolidated accounts. But that does not mean you are exempted to the sense that if you yourself want to do it, you cannot do it. No. You yourself can decide to do it. But just that it is not forced. You are not forced to prepare. There's no regulator who is going to force you to prepare. So you can be exempted from preparing consolidated account. Right. Okay. So one other thing that I want us to understand when we talk about consolidation is the mechanic of consolidation. Mechanics of consolidation. So today what I wanted us to deal with is to talk about the investment levels, also talk about what we term as control, and also talk about the circumstances under which we can be exempted from the preparation of consolidated accounts. So what I will do is I'm going to end it here for today. God willing, next day, another time, we will continue and talk about the mechanics of consolidation and have some level of preparation or hands-on calculation on these mechanics. When we talk about the mechanics of consolidation, it is these mechanics that will help you in the preparation of what? The consolidation. So it's not anything different. We are talking about the components of preparing what? Consolidation consolidated what account, the components that you need, which will help you in the preparation of what consolidated account. We will try. I don't want us to prolong our videos, so we will try as much as possible to make it short enough for you. So today we are going to end it here. Then, God willing, another day we will talk about the mechanics. Wherever we get to, will be fine. So we talk about some of the mechanics and continue with others subsequent. So, without much ado, we will end it here for today. But please and please and please again, kindly try to click on the subscribe button and then share the videos to friends and families to also help us improve our YouTube account. My name still remains Edward, and you can call me Ed for short. Thank you very much. Bye bye.